On the call this morning, we're fortunate to have my guest. His name is Beau Beery. Beau is a principal with the Coldwell Banker Parish in Gainesville, Florida. He's also the lead on the Coldwell Commercial. And I may not be saying this exactly right. We've talked about it here. I'm going to let him help me out here. But Coldwell Commercial and the Barry Rainsberger Group. Beau has his CCIM designation. He's also got his master's in real estate from the University of Florida, and he specializes in multifamily. Beau, welcome to the show.
Thanks, Darren. Appreciate you having me.
Yeah, I'm excited to get into this. Before we do, I gave you a little kind of a very brief introduction. If you could do my listeners a favor and tell us a little bit more about you and how you got into real estate.
Sure. So I acquired Coldwell Banker Commercial in Parish back in 2011 with partners Jay Parrish and Todd Rainsberger. Prior to that, I was with the main commercial developer called AMJ in Gainesville. I was with them for about 10 years after my master's degree. And it was there where I learned really great skills on the investment side of real estate and how to acquire office, retail, multifamily from a principal standpoint. And so it's a great background on the brokerage side, because instead of just going right into brokerage and not having that background about how to protect your own butt, it's a little more difficult. And so in 2011, I was with Coldwell Banker Commercial. Within Coldwell Banker Commercial, my partner Todd Rainsberger and I created the Beery Rainsberger Group, which is our self-production company, if you will, where we practice commercial real estate. Todd and Steve McKinney, our other partner, and Tracy Ross handle a lot of the general commercial real estate deals, office leasing, retail sales, industrial stuff, land stuff. I exclusively do multifamily brokerage. So that's putting buyers and sellers together on apartment complexes all over, mostly Central and North Florida, anything from 10 units, for a small investor, up to, several thousand unit portfolios, if you will. And so all day I'm having conversations with investors and trying to find them assets to acquire and helping them sort of underwrite the deals. My specialty, if you will, within multifamily is underwriting and doing it conservatively so you don't get caught with your pants down after closing.
No, I think anybody that's been caught with their pants down can appreciate that. Better to know what you're getting into before you do.
Yep.
Well, thanks for bringing us up to speed there and sharing a little bit about your background there. I'm excited because today you and I, we set up the call here and we're going to get into kind of the investment pro forma and kind of the line items and you're going to take us through kind of what an investor needs to be aware of. And I also want to point out for the listeners, I'll do it two ways. I'll give it a screenshot here when I do the edit, but also I'll make it available as just an attachment. So if you want to go through this with us, you can follow along and see the numbers, because I think if you're like me, and I think most people with numbers, there's a point at which you can do a couple of numbers, but eventually you got to see them for it to make sense. It tells a story there. So with that, I think should we get into this a little bit and go through it?
I'll just hop right into it. And while I've created this thing, a lot of the numbers are not. If you can't see the numbers while we're talking, it's not going to be a big deal. It's how I evaluate each line item and what to look out for that's most important. So for the listeners out there, don't fret if you aren't seeing it as we speak. But what I'm going to do is I'm going to go through how to look at a 150 unit apartment complex would be my scenario. This scenario on how I look at acquiring an apartment complex can be for a 10 unit community, a 20 unit community. A lot of this stuff could be for acquiring a retail center or a multi-tenant office building, or it could be for a 500 unit apartment community. A lot of the principles I go through will be applicable as well. And so when I'm underwriting, all I'm thinking about is, what will this thing look like when I own it after closing, because the way it looks to me is almost 99.9% of the time completely different than what it looks like to the current owner for a number of reasons, which is what I'll go through now. So the scenario is 150 unit, $10,350,000 community. And so when I've acquired the rent roll and the income statements from the seller, I then sort of plug them into my own software, which isn't anything extreme. It's what most of you would understand, and I've kind of put it on a piece of paper that you'll produce. But I go through line item by line item on the income, the expenses, and then I have a number of indexes that I go through to make sure everything sort of lines up. And so on this particular scenario, you got 150 units whose gross potential income stated by the seller is $1,650,000. Now, the first thing I do when I'm looking at the gross potential income, now the gross potential income is obviously what you could achieve if it was 100% occupied, right? And so I always tried, I'll look at what he has shown as what he has in place, but what I'm looking at to see is, well, how does that compare to the market? Okay, so if his gross potential income backs out into $1,100 a month rents, and I know the market to not be able to bear under any circumstances $950, I've already got a problem day one. Like,
right.
that's not looking right. Okay, so I need to look at what his gross potential income is. So then the next line item typically is sort of a combination of vacancy, concessions, okay, which is what kind, do you have to give a free month? Do you have to give away a TV to a tenant? And then there's bad debt, which is, late rents or not unpaid rents. And so I want to see what he is putting for those vacancy, concessions, bad debt as compared to the market. In my scenario, I'm using 10%. The national average is around 8 or 9%. And in all of this, I use a lot of stuff from the National Apartment Association operating expense report that they do every year. And so they literally have what typical percentages of gross income is or per unit expenses are, line item by line item. And so I know just from those indexes, which is taken from thousands of communities all over the country, so it's pretty darn accurate data, what things should look like. And then based on my own experience, depending on the size of the property, where it's located in the country, I can sort of adjust those numbers. So when I see $1,650,000 and I get past and I say, okay, well, that looks about right. Then I look at the vacancy, he's got 10%. Okay, that's about right. Obviously, if he had 3% in there, that's total BS. Because there's no way, I mean, even if you're leasing things right away, Darren, because you have investments yourself, you still have to replace carpet, you have to paint walls.
Right.
That's just not possible, right?
Right. Haven't been able to turn one overnight yet. So.
Exactly. And then, of course, you've got concessions. I mean, even in good markets, sometimes you have to remain competitive. You may even give a couple weeks off, whatever it is. So then when you have potential gross income minus vacancy, that what's left over is called effective gross income. And then I start jumping into expenses. Okay, this is where I get down and dirty. So anytime you get over about 70, 75 units on the apartment side, you typically have on-site staff. You have an office. You oftentimes have a clubhouse. You have a pool. You have other amenities. And so that 70, 75 unit plus is a total different jump than the 10, 20, 30, 40 unit community. And I'll talk about each of them and how they differ on each of these expenses. But since this is a 150 unit deal that we're looking at, there's a couple of expenses for administrative. For example, the first one would be administrative expenses. Now, on a larger community, these are things like the copier machine, the paper, computer expenses, the power within the office there, phone, all those things happen within a larger community. And so in this scenario, you've got about $250 per unit expenses. That's about right. That's in line with It's in line with national averages. If I came in here and saw 500, 600, 700 bucks, I know that what's probably happening here is that this is probably a very large owner who may be also mixing in his corporate expenses. Okay, so his office in Atlanta that runs 75 apartment complexes, he may be throwing that some in there, or something's just not right, so I need to ask questions about it.
Right.
Anything under 70 units, you probably won't see an administrative line item at all. There's no clubhouse, there's no office, there's no reason to have copy machines. Now, you may have a home office with all this stuff, and if you only own 1 or 2 communities, it would be smart to go ahead and throw that in there, but if it did, it would just be a very small number.
Right, but it's not including any kind of payroll or salaries or anything like that. This is just the facility kind of whatever expense, like you said, copier and electric or would electric. I mean, office electric, that kind of stuff in there. Or would you? No,
electric would be under a utility line item.
Okay.
So the next one I have on here is contract services, and this is no matter what size the community is. It could even be a retail center, it could be an office building. Contract services are all the things that run a property that you have a contract on. For instance, landscapers, the pool cleaners, termite, pest control, garbage collection, all those things that you typically have a contract on. That's what I'm looking at. Now, I know almost all communities run for somewhere between $250 and $450 a unit, okay? And so in my scenario here, I have $325 per unit. That sounds about right. So when you lump in all those different vendors in there and you look at that, that looks good. Now, listen, if I see something in here that has $100 a unit, there's an issue here. Number one, that says to me, it's probably a small apartment complex that I'm looking at, and the owner is probably mowing the lawn. The owner is, using his own little rotator to spread the pest, to spread the termite and pest control or the fertilizer or whatever, and so that's just not real.
Right.
And oftentimes the problem is that 20-unit seller, okay, doesn't put those expenses in there. He's probably just putting the actual vendor for whom he's paying and not including the fact that he's mowing the lawn because he's not putting expense on there.
Right.
Well, that's crap. You're going to have that expense.
Let me ask you along the lines, you brought up those expenses that are accounted for normally and are expected versus those that a owner-operator of a smaller property might not. Is there a threshold number of units where you find that the accounting is more normalized, where you're seeing all of that, as opposed to, I mean, is it somebody that's operating 40 units is more likely to have it? Is it somebody that's operating, once you get to more, like you said, on-site staff, is that going to be more of the point where you see it?
Realistically, the rare times these days in which I see someone actually physically doing repairs or mowing the lawn is like under 10 or 15 units.
Gotcha.
That's typically where I see it. And those guys only own 2 or 3 small communities like that, or they own a few homes in a 15-unit community. But listen, and it's usually in markets in which there are super crappy property managers, right? So like really small towns that the owners had bad experiences with the property manager, so he's never hiring another one, so now he's doing all the work himself. That's typically where I see it. But almost everywhere, when you hire a property manager, their existence in this life, number one, obviously, is to save you time, but number two, they should be paying for themselves. They have connections with these vendors that they can get price reductions that will save you money. And number two, they know how to price things correctly and get you the most amount of rent. So they should be paying for themselves all the way through. I usually don't see guys who are doing all the work themselves, but contract services and repairs and maintenance, which I'll get to later, those are the 2 line items which I know are giveaways in which I see totally wrong numbers or underpriced numbers.
Gotcha.
Yep. So the next one is insurance, and this is probably one of the top 3 or 4 biggest issues I see. So especially on the larger community side, on the insurance side, so we either see no insurance that a lot of the big players will self-insure, which means they're so big and they're in their own communities in which there aren't, major volcanoes or horrific hurricanes or frequent tornadoes. They'll just self-insure and they'll just roll the dice, and any catastrophe wouldn't be as great as they would pay for insurance on thousands of units. Okay, that's kind of rare. What I often see on the big players is they'll have a portfolio insurance policy, which I'm sure you know. So a smart insurance guy will call a big player who owns a number of communities and say, hey, I can save you on insurance by writing one master policy for all your communities, and there's a lot of savings there. Well, the guy buying that one particular community isn't big enough to have a master policy, and so he needs to look at this as though he's getting insurance for that one property. So almost in all cases in insurance, as a buyer, I would, number one, talk to the current insurance carrier and see, does that same price and terms still apply to me? And if not, go and bid it out. The second thing I want to look at for insurance is, what kind of coverage does he have? If he's big enough, is he writing it for enough amounts? Does he have, is the liability amounts correct in there? You're an insurance guy. You know how this goes. This is a big issue, and I see oftentimes the price is always way low.
Yeah, no, and I've seen it where they just don't have the coverage. I mean, like you were saying, is either they self-insured a certain thing, and that may not be understood by the broker. And I don't even know if the buyer or the seller fully understands what they've done. I was, guy not buying wind insurance on the coast in Florida. I thought that was kind of weird, but
Right.
Okay. But no, you're right. I mean, it's insurance is kind of it's not the easiest thing to understand, and so if you're assuming the seller's numbers and it doesn't have the coverage that you need, or you're not able to achieve that price, you're going to be surprised, and your budget will be upset if you don't have a real number that you can bank on. So
Yeah.
that's
And
why
Darren, you're an expert on insurance, clearly, and where I see this most are guys who own the communities cash, right? There's no lender because, lenders require insurance. And so it's usually that 40, 50 unit guy who probably hasn't had a hurricane or tornado in his area for 20 years. He doesn't think it's ever going to happen. He's never had a fire. He probably hasn't owned enough to know all the war stories. So he owns it cash. He has an insurance policy, but he's written, for $200,000 per building, where there's no way in hell you could replace it for less than $800,000.
Right. No, or just liability only. I had one guy, gave him the price, and because of the condition or whatever it was, he said, "I'll just do liability." He was more concerned about the trip and fall. I was like,
Right.
That's not necessarily going to be your buyer there. But no, there's. I appreciate you pointing that out, because that's the world I live in. So that's good.
Yeah, and insurance is too cheap. The catastrophe that can happen is just it could just propel into all of your life and just take down all your properties if you're simply uninsured on one property.
Yeah, no, and it's an operating expense. You need to account for it. It's part of how you get to the numbers and make the numbers work. And if you're not, taking that step to have that right, you're really setting yourself up for one slip on the banana peel, and all of the plans you have for your future could be gone. So
Yeah.
good.
The next line item I have is marketing and advertising. So here's the thing. Every big property has this line item. Every small property should have it, but stuff under 50 units, I hardly ever see it. And I just think it's just not a good idea. Even if you're in a phenomenal location and all you've had to do for the past 20 years is put a sign out front, I encourage to having, anywhere. It's typically anywhere from 75 to about $150 a unit in general. That will get you on all the websites where rentals are. That'll get you to, you can do mailings with it. You can do sponsorships. You can, put your community in magazines and so forth. Why not create, even in a phenomenal location where you've never had to advertise, why not create this tremendous demand for it, so that you have almost a waiting line, and that allows you to increase rent, and that becomes, you almost create a brand out of your 30 unit community. And
Right.
that's what the 150 unit guys are doing. I mean, they're putting their community out there almost. I mean, those guys really have to do it just to stay competitive.
Right.
And so they're in magazines, they're in websites, they're creating websites alone for their own community. You got to have a marketing advertising thing. If you don't see one in there, you need to put one in there and underwrite it with it in there. I would put in $100 a unit in there as sort of a line item. You can go a little bit less depending on what kind of community and competition you have, and put it in there.
Okay.
Okay, management. We're about halfway done with the expenses. Management is a big dog. Management, I mean, listen, first of all, when I go to acquire anything or working with any guys who are savvy in this, when they go to acquire, they bring their property managers on the visits. I mean, this is one of the most valuable people on the planet when you're buying office, retail, apartments, industrial, whatever it is. Bring your property managers with you. They are at the sort of just the lowest level of being able to operate a property. They know everything about it, the ins and outs. They know how to spot stuff that even at your high level of acquiring, you could never understand. And they're supposed to make you more money in the end. So when you're reviewing line items on the management side, that stuff typically is 3 to 5% of effective gross income for larger properties, 150 plus units, 100 plus units, 200 units. That's about what it runs. And then as you get smaller, under 50, 60, 70 units, it runs anywhere from 6 to 8 to 10%. And sometimes there's new lease fees, there are renewal fees. Obviously, the smaller the community, the more it would cost to manage it just to make it worth it to them and to keep them enticed. And so when I get under 50 units, oftentimes I won't see a management line item in there at all because the guy is self-managing. Big no-no. Number one, if you're acquiring this and you're getting a loan, which a lot of under 100 unit people are, the bank requires it because the bank's thinking to themselves, okay, if this guy fails, I need to make sure that I can put this with a management company and there's enough income coming in. So in the bank's underwriting, they're making you put it in. The bank is making you have insurance in there. The bank's going to make sure you have management as well as a couple of the other line items in there already. So on the management side, that's what I'm looking at. Super key who you choose. Obviously, the more like-kind property that folks are managing, the more calls they're generating for your type of asset. Okay.
Right.
Repairs and maintenance is the next line item. That is typically over 100, 150 units. You never see much fluff there. Usually that stuff is running anywhere from $500 to $800 a unit, and I rarely see it veer from that at that level. I mean, those guys aren't really cheating. Anytime you're getting over 100 units, it's really hard to fool an investor or put in some bullcrap line item. However, under the 50, 60 units, this is where I see so many deals killed because it's just so much garbage put in here, mostly because they're either self-managing or the property manager they're using isn't keeping proper records, or they're just delaying maintenance. They just aren't doing repairs, and they have properties that are in shambles. And so if you're seeing anything less than $400 or $500 a unit in there, it's garbage. Like that it isn't possible to run a property. And I'm underwriting one right now, right? I'm seeing like $150 a unit for, this is a 25 unit community. I'm telling the guy, run away. Like that's not even possible. I mean, you know that. You own multifamily yourself, not possible.
Right.
So make sure that those amounts are in there. The next one, property taxes, there is probably the number one or number two most highly deal-killing line items I see on a regular basis, particularly on larger properties. So many apartment sellers over 100 units, or really of any size, especially the ones who have owned communities for a long time, usually have a low assessed value. So for property tax purposes, a deal that's worth $10,350,000, okay, that's under contract, his assessed value, which is for property tax purposes only and has nothing to do with market value oftentimes, could be $7 million or $6 million, right? So he's being taxed at $6 million. This guy's about to buy it at $10,350,000. The seller of a $10 million community, even though they would never buy something and not account for the increased price, suddenly gains amnesia when they're selling and think that the property taxes they are paying should stay at that amount.
Right.
Even though they would never do that. So I have run a property tax study in every one of the Florida municipalities in which I operate in. And typically what I see is, though this is not how property appraisers do it, I see it's usually somewhere between 75 and 82% of the purchase price is what the assessed value ends up at the next year. So if you bought something in 2016 for $10 million, when you're underwriting it, you should probably underwrite it at about 80% of that purchase price times the millage rate, and that's what you're putting in. And almost always, it can oftentimes be double what the property taxes are now, depending on how long that guy has owned it.
Yeah, because isn't there a cap on how much they'll increase the rate or the value annually once you lock in? If you bought it 10 years ago and
there is in a lot of states, and when you the way the property appraisers actually do it, at least in the state of Florida, is it's a combination of how all appraisers do it, which is it's a combination of replacement value, the income approach, okay, so net income divided by cap rate, and it's replacement cost. So, or sales comps, excuse me. So those three things are combined. That's how they actually do it upon every sale. And they mix them all together. But you never know what they're using. And so from the outside, what I do is I run a study on, okay, what is the sort of the average and median from the next year's assessed value. So what I did was I always, every year, so I take the 2015 sale price and I take the 2016 assessed value and I do a division to see what it was, and the average was anywhere between 75 and 82% on the markets in which I cover in Florida. So I use roughly 80. So in this scenario, on a $10 million property, this guy is probably paying, $90,000 in taxes. Well, if you take 80% of $10,350,000 and multiply it by, let's just say, a 20 millage rate, you're going to come up with $155,000 taxes. So it's going to go up dramatically. And that's a big deal. I mean, listen, if you're paying $90,000 now in taxes and it could potentially jump to $155,000, that's a $65,000 jump. Divide $65,000 in income by, say, a 7% cap rate, that's a huge number, right?
Right.
That's always the delta. I mean, that's always a big, big number when I'm looking at stuff. So make sure you're underwriting at somewhere around 75-80%. Okay, and then don't come at me if it ends up being 92%.
Right. Hey, so, and I didn't run the math here. How does that 155 that you've got in here?
I think I did that on 80% of 10,350,000.
Okay.
And so using 20 millage rate. Let me see here. Actually, I did that at 75%.
Okay, so you were using something that's relatively reasonable as opposed to something that was historically discounted. So
yeah, and then using 20 mils, so 0.02. So here you would take 10,350,000 times 0.8, or excuse me, times 0.75 times 0.02.
Gotcha.
That's how that would work out. So the next line item is salaries. Salaries you pretty much only see with larger communities. These are on-site leasing agents, property managers, and on-site maintenance personnel. And that stuff typically runs anywhere from $1,000 to $1,500 a unit, right? So that's mixing in their salaries, their federal withholding, all that stuff you got to pay as an employer. You mix all that in. That's about what it runs. And so If you're seeing much less than that, they don't have enough leasing guys on there, or they don't have enough maintenance guys on there, and you should probably look at the property to see how it's maintained. My guess is if they've only got like one maintenance guy on there for 150 community, the place don't look very well, and you got a lot of complaints.
Right, right. So in my my thinking here, real quick. So if you take the salary number and you add that up to the management number, how have you ever done a comparison for, like, as you were talking about, like in a smaller community where you've got anywhere from 6 to 10% management fees?
Yeah.
Do the salaries and the management fees on the larger properties combined, do they run similar to that? If you
Good question. I can go that plus that. So in this case scenario, you're around 16%. Okay, so definitely that's me adding, let me make sure I did that right, management and salaries, and then dividing by the effective gross income is around 16%. Or if you did it by the gross income, you're at around 14.5%. So it's a little bit more. But the management guys are typically running the salaried employees. So
Sure.
most of the time when you hire a third-party manager, they're the ones who then staff the apartment community oftentimes.
Right. What I'm just wondering too is when you've got that on-site management and staffing, I'm assuming that your repairs and maintenance, the labor in that would be somewhat absorbed by that your staffing.
Right.
So as opposed to if you're outsourcing all of your repairs and that turns, et cetera, that number would probably be larger on a percentage wise, as opposed to maybe a smaller management number on a smaller community.
Yeah, that's right. And obviously, smart community, you wouldn't have salaries at all. Like, it just doesn't exist. The manager's doing that, but the manager also has pretty good connections with vendors that are on smaller communities, and so while the management number will be higher, I think, on some of the smaller communities, it's not going to be all that much.
Got it.
Yeah. So only a couple more line items. Utilities, for larger communities, it's usually a little bit more. I've got around $500 a unit is kind of plus or minus a couple $100 here and there, depending on. This is a deal in which the tenant pays all the utilities.
Okay.
It jumps quite a bit if it's a utility included community, but this non-included scenario, this is the lights on the building, the lights in the hallway, the clubhouse, the electric for the pool. It's all the things that go into running a larger community. It's much less on a small community. Small community, you have the vacants. So when someone moves out, you have to leave the utilities on to clean it. You might have a couple building lights. That's about it.
Right. Do you find, are most of the properties you're dealing with, are they all separately metered? Or are they doing the rubs to charge back to the tenants for the utilities?
So, utility included stuff is mostly student communities. That's where I see that.
Okay.
Or it could be a conventional market rate community, but it's typically much older. So a lot of the 1960s, 70s built concrete block buildings that are occupied by non-students, those oftentimes have all the utilities included because it just wasn't ever separately metered.
Right.
And it's super expensive to do it. And so oftentimes those communities haven't been upgraded to individual metering because the cost repay back in that community, oftentimes the rent may not pay for it. Like, there's just not enough rent there.
Right.
All the ones that have been converted are in markets in which the rents make sense to do so. So they've done it already. Got it. And then the last item is the other of the number one or number two most highly debated expense line item that is it's not necessarily a big one, but it's always debated about whether or not it should be above the net operating income line or below, which is reserves. I don't see how, I guess I see how, but I am an avid believer that reserves should always be above the net operating income line. In other words, it should be included as a regular expense. And reserves are, these are the capital expenditures. So your roof, replacing an air conditioner, repaving the parking lot, updating kitchens and bathrooms like entire units, all of the major items that are long-term expenditures, those are real expenses. And to not account for them in your line item is going to really screw you up. Now, I've got three, it usually ranges from $250 to $350 a unit. That's what banks use. That's what banks require, okay, if they're going to lend to you, to have in your line items. And that number is about what they use. The reality is that for especially 150, 200 plus unit communities, the national average is it's over $800 a unit.
Really?
That's what you actually end up spending, because you have to become competitive. I mean, everyone around you is keeping their kitchens and bathrooms updated. They're remarciting their pool. They're pavering their pool deck. That's the actual expenditure. Now, when if you put in a big fat number, $800 to $1,000 a unit when you're acquiring, you're probably not going to win the bid because it's just a little too much.
Right.
But you really need to put something in there. I typically use $300 to $350, and if there are imminent capital expenditures that need to be done right now, I just deduct those actual expenses from the price rather than creating too big of a line item in my annual underwriting. If you understand what I'm saying. So if the roofs are completely trashed and it's $80,000 to replace the roofs, you can't put in $80,000 amortized over 20. It would just kill your pro forma.
Right.
I just take $80,000 off the price and negotiate with the seller.
Right. Right.
And I just maintain a normal reserve line item, unless there's other circumstances of the property that require just a higher regular reserve budget.
Well, and to your point, though, I think it's one of those things that people look past in a hurry when you're running your numbers. It's going to happen. I mean, roofs, paint, carpet, toilets. It's all there. Water heaters. I mean, it's what makes the world go round. As far as expenses there, and if you're not ready for it, you're going to be wondering why your numbers don't add up. So
yeah. So that's all the income and expense stuff. And then to wrap it up, Aaron, I have 6 or 8 indexes that really pull things together for me that are kind of the nerd in me I love. Like, these are the numbers and the line items that tell me whether this thing is real or not. So the first is expenses per unit. So in this particular scenario, all those expenses, when you add them up, came up to about $4,900 a unit, which is about right. The national average for larger communities is it's about $5,500 a unit, somewhere in there. That's with reserves.
Do you know the number for the smaller communities? Is that vary greatly?
Yeah, smaller stuff. Typically, if you go under $4,000 a unit, I get worried, like something's wrong. If you're active in the management and doing some of the repairs, I've seen $3,250, $3,500 a unit. That's certainly possible. But typically, if you're running a tight community and it's looking nice, it's hard to do it under $4,000 a unit, even for small stuff. Okay, if you've got a property manager and you've got reserves in there and you're running things legit, it's hard to do it under $4,000. It really is. If you're buying quadruplexes, 8plexes, stuff like that, $3,500 a unit is probably fine. That's not going to be out of the ordinary. So the first line item. That's
a good, just a reference point, I think, just for anybody looking for, trying to run the math, and if the numbers, absent, in your mind, you're going to know that at least a number for an expense you should be putting in. If you just said $4,000 a unit, and multiply times the number of units, you're going to have at least an expense you can run against the income to determine if what an NOI should be, or ballpark, that kind of thing. So that's good.
As a matter of fact, Darren, the first thing I do, I mean, as you can imagine, as a broker and as many investors listening to this, one of the first things they even do is they just take the total expenses, divide by the number of units to see what the expenses per unit are, and they literally just go, gone,
Right.
delete. Like, you start seeing stuff that's $2,000, $3,000 a unit. Like, that's just total lying, total garbage. Move on to the next. Like, you don't even have to look at all this other stuff.
Right.
The price per unit on this one of $69,000. Okay, that sounds about right because the average rent here is about $900, $915. Like, that actually looks like a pretty good deal. So I'm going to continue on. The debt service coverage ratio, that's a big one. So on this scenario, I don't have it on the sheet I sent you, but I underwrote this on using a 25-year amortization, 4.5% interest rate, and I think I did 25% down. Okay, so when a lender is lending to you, they want to make sure that you have enough net income. Okay, so income after expenses, enough net income above their debt service to live on and to make sure you have a healthy community. Most banks want 1.2 or more. In other words, they want 1.2 times more net income than debt service to service it.
Right.
So the actual equation is debt service divided into net income. Okay. In this scenario, it's 1.44. So a bank's going to like it.
Yeah, it's pretty healthy. That's good.
Yeah. Our overall operating expense ratio on this particular property is about 50%. That's about right. I mean, there are some communities that run between 40 and 45%. If you get down to 40% with reserves included, you might want to start looking at it, make sure it's just kind of go. That's when you need to go line item by line item. But 45 to 50% with reserves in there and the proper property taxes and management, that's about right. I just underwrote a deal that had 25% in there. Garbage, delete. Like, I'm not even going to look at this any more further for my buyer. Totally stupid. And, I'm not even going to waste my time talking to the seller about, hey, show me your tax returns, and that's garbage. Like, those guys just don't get it. Okay, they're trying to pull over a fast one, or they're just not keeping, or they didn't even hand you tax returns. They just, wrote down numbers to their broker and didn't give the right stuff.
Right, right.
And the operating expense ratio that's basically all your expenses divided by your effective gross income. Effective gross income, if you remember, is total income minus vacancy.
Right.
So that's your expense ratio. You don't want that to be certainly less than 40%. And if you start getting above 55, 60, then you probably have a lot of old air conditioning systems. The property manager is charging too much. There's way too many salaried employees. There's a whole bunch of things that could go into that. The one I really like almost the most is gross rent multiplier. Now, a lot of the new guys think that that's kind of an old fogey type thing to use. Gross rent multiplier is simply how many times your total annual income is divided into the price, right? So in this case, it's 6.25. Okay, so this gross annual income of $1,650,000 divides into $10,350,000 price 6.25 times. Most stuff is between 6 and 8. It's kind of a healthy gross rent multiplier. In other words, if you were well above 8, that typically means that a buyer thinks that these rents are probably way under market. And so he's willing to pay more times the gross annual income because he thinks the rents are well below and he can gain more rent. That's
right.
Or could
kind of
be
like
that,
it's almost like the reverse of the cap rate, is it? I mean, as far as the number, if you're buying a bigger gross rent multiplier, expecting that there's room to raise the rents.
that means the cap rate will be lower.
Yeah. Yeah, to where you if you raise the rents, then you would have a higher cap and a lower gross rent multiplier. Am I reading that right?
That's right.
Okay, gotcha.
Yeah. And so the other way around, if it gets much below 6, you're getting I've seen 3s and 4s all the times. Those are possible. It just means that it could be in a bad area. It could be distressed. The management's not good. There's I mean, that doesn't mean it's a bad investment. It just means that there's some possible value add there that you could bring to the table. So that's one that I like to look at, and it just kind of gives me a round picture. Probably my favorite as an investor. I mean, listen, there's some other more important ones, but to me, the break-even occupancy, that calculation is fun to me.
Yeah.
So the break-even occupancy is if you add expenses plus your annual debt service, and then you divide that by your gross income, right?
Okay, so what was that? Expenses plus what
expenses,
was that? Oh, plus debt.
Plus so if you were to take your total principal and interest payments for the year, plus all your operating expenses. So in this case, it's $740,000 in operating expenses, plus the total debt service. And I know I didn't include that on here, but if you were to run a mortgage runoff off those terms I gave you prior,
right?
You take that's your total expenses. Like that's everything that cost you money in this deal, and you divide it by the total potential gross income. That will tell you what your break-even occupancy percentage is. In this case, it's 76%. So what this says to me is I can get all the way down to 76% and still float this property. And so in this day and age,
it's pretty healthy.
It's really healthy. I mean, I don't see many healthy communities at all in this world below 90%. Okay, if you're below 90%, you probably have some distress. If you're below 85%, you've definitely got a distressed property. So to be able to go down to 76 in this scenario, like that makes me feel really good. That's kind of like my oh crap factor. Okay, if this read 89%, 88%, 87%, even if its historical occupancy has been 94, 95, that makes me sweat a little bit, dude, because we're at the height of the market right now in multifamily. And I don't think we have much time left before we're going to start seeing a little bit of a reset. Nothing incredible. Multifamily is always going to be the darling. Everything's pointing to rental. Rental rates are way up. But there's still going to be a concession period coming up here. Things are going to start leveling off. And if that break even was 88, 89%, like I'm sweating. I don't care if I've had 96, 97% for 5 years. That makes me sweat. Then the other
sweat because you're thinking that they haven't maintained the property or they're not able to attract.
No, because if my historical occupancy has consistently been 95%, but I've only got
cushion.
The cushion's just not.
Yeah. Okay, gotcha.
I mean, dude, listen. If a terrorist attack happens in a major area in anywhere in the United States, there's mayhem and people just start flighting, right? And you start giving concessions, and your expenses go up, and your vacancy goes up, and a 6-point swing just ain't enough for me to feel good about it. Right.
Makes sense. I got it.
So the next, so there's only three more indexes left. The cap rate. A lot of people in this business know what capitalization rates are. Cap rate is simply net income divided by purchase price.
Right.
And that's so basically if you were to pay cash for this thing and the net income divided by that, all the Class A properties are typically under 6%, and a lot of them, believe it or not, are under 5%. I mean, this is like hardcore Miami, New York, the Maine. Really nice stuff is under 5.5%.
Right. That's out here in Portland. I know that's the case. All the new stuff is pretty slim.
In Florida, I mean, you certainly see some stuff under 6. Really good properties is 6 to 6.5. The B stuff is 6.25 to probably mid to high 6s. And then most stuff is falling in that, most of the sort of the C stuff falls anywhere from 6.75 to 7.75. And then anytime you start getting above 8, it doesn't necessarily have to be distressed property. It's just not that great of a property. Like it's not, there's not a whole lot of value you can add to it, or it might be a smaller deal. In this scenario, it's a 7.2 cap rate. Cap rates I view as it's sort of a risk return rate, right? So these aren't things you can look up. They're not published, as in other words, you can't look up a Miami index and say you should only pay 5.2%. It's really it's an investor-driven, market-driven rate. And so, for instance, back in the day, a Dollar General, back in the day was 9%, because typically they weren't like nice-looking buildings. They were usually industrial-looking buildings. They were in small podunk towns that if they ever moved out, you'd be stuck with forever, right?
Right.
Whereas a McDonald's is one of the most highly sought-after assets in the world. Those trade at 4.5% all day long, okay? So you have Dollar General in 2009, we're at 9 and 10%. And McDonald's today, McDonald's is what I call mailbox money. You literally you just go to your mailbox, you pick up a check, and that's it. You don't have to pay property taxes. You don't pay insurance. They pay for all that. They never bother you. They're there for 80 years. And so someone's willing to accept a much less return, hence 4.5%, because they never have to touch it again. It's typically phenomenal real estate. Or it could be, or on the flip side, if you got a 7-8% return, cap rate, other type of retailer or apartment complex, that means, hey, I want to earn a little bit higher returns. I've got a little more risk. I've got a little more, it's not as great a property, or whatever the case may be. And then the last two indexes I look at are, what's my cash on cash return? Cash on cash is, that's your income after all expenses and debt service divided by what you have in the property, which is your down payment on your mortgage plus closing costs. So if you had to put down 25% on this property, plus you had another 2% in closing costs, and your income after expenses and debt. So it's income after expenses and debt service, that's your cash flow, divided by the summation of your down payment and closing costs. And on this scenario, that's about 8.25%, right? So that's the actual money I'm going to take home after I've paid all my expenses and my debt, divided by the money I put down, right? So that's a pretty good return. That's not amazing. That's what a lot of the publicly traded companies go after. That's what big companies, if they can earn 8, 10, 12% cash on cash, that's not a bad number.
Sure, that's better than the bank. So
yeah. And then the last one I look at is, what a lot of us get into investment income property for is the fact that our tenants are paying our mortgage, right? And that's a big deal. So the cash on cash return doesn't take into account the fact that your principal, the principal part of your debt, is being reduced every month by your tenants. That's phenomenal, And so I look at what I call my before tax cash flow with principal reduction, So that is your income after expenses and debt service, but then adding back in your annual principal reduction divided by your down payment and closing costs. And so what I do is once I run my mortgage stuff, I create this 360 or 280 payment scenario, and what I do is I find out what part of my annual debt service is principal, and I just kind of add that back in there. So in this case scenario, you've got about a 14.5% return. So that's my real deal, nitty gritty. That's my wealth creation return, and that's a damn good return in the market. Okay.
Yeah, and are you projecting, is that just the first year? Because your principal will naturally
Might do
increase
it on
over.
the first year, but you
Okay.
can do it whenever. I mean,
Sure.
obviously, your actual principal reduction goes up every year, right? So
Right.
every year, principal goes up and your interest goes down.
Right.
So your first year is what I run it on because that's your worst case scenario.
Right.
And so a 14.5% return, that's pretty sweet, right? I mean,
Yeah.
that's what I really look at. And as long as all the other indexes turn out good and I got a 14.5% return, like that's a moneymaker.
No, I like that. I've always thought of that. I'd never had anybody kind of spell that out for me, because that's always been the case. And my thinking on real estate was, first and foremost, was that principal reduction. The tenant was paying my freight, they were paying down my mortgage, and at the end, if I just held on to the property, I'd have an asset that I didn't pay for. It's
Right.
kind of just a real simple way of thinking about investing when I first started. And but that's cool to actually be able to put that into a percentage and actually look at like, wow, okay, that's
It's neat. Now, it assumes you've sold it, right, and you got back all of that principal reduction and doesn't take into account you hiring a broker to sell it and the closing costs at that time. So it gets reduced a little bit at that time, but it also doesn't take into account the appreciation that's happening.
Right.
Okay, so usually, if you bought correctly, the 14.5% return should be worst case scenario because you've been increasing rents, right? And you've been increasing the value of the asset, and that increase should far compensate for a commission or a closing cost in the future.
Right. No, I've looked at this and talked with my other friends that get into stocks and all that stuff, and I don't care what you're in. There's a transaction fee, whether you're getting in or out of real estate or you're getting in and out of stocks or whatever it is. So you have to be aware of it and know it's going to be part of it. But no, this is awesome, Beau. I really appreciate you going through this. So, and I want to go back because you pointed out there were like three things that I wrote down that you identified as some key numbers, and one was the property taxes for buyers to be aware of. Is just to know that the property tax. Understand that if you take your millage rate and about 75 to 80% of the value of the purchase price is probably about what you're going to be taxed on, as opposed to what the seller was taxed on. The reserves. We talked about the reserves and how if they're not showing it, you better account for it. And you indicated some standards, some national averages and stuff, but recognize that in a competitive deal, you probably aren't going to be able to account for that full thing, but you need to have a number in there. And then
and Darren, just on that little, because reserves is probably one of the smallest line items, but is important. Just to give you an idea of how impactful it is, because many people, especially sellers, when they're selling the property, they don't try to include reserves, right? A lot of these guys, they think, oh, well, that's not I don't have that expense. I don't have that expense. Even though when they go to buy it, they try to stick it in there. But in this scenario, at $300 a unit reserves times 150 units, that's $45,000, right? Which among all this is one of the lesser line items. But you take $45,000 and divide that by a 7% cap rate, which is how the stuff is valued. That's almost $650,000 in value.
Yeah.
Right? So you would be overpaying $650,000 right out of the gate on one of the smallest line items if you did include that in there.
No, that's huge. I mean, when you back it through the cap rate, that is huge.
If it's not huge, send me a check.
Yeah. Yeah. Beau Beery. And then you also mentioned the insurance, which I appreciate you sharing that, because that's, as we talked, I've clearly seen that be an issue and something you've got to pay attention with to make certain you've got yourself covered on that.
Big time.
So, Beau, we've been going on for, time's flown here. Just looking, I think it's coming up on an hour. I want to be respectful of your time, and before we go, where can the listeners find you and learn more about you and your operation?
Sure. um, I've got a website, beautodd.com. That's BEAUTODD.com. You can flash it up for them. That's myself, Beau Beery, and my business partner, Todd Rainsberger. It's kind of our combo name. And on that website, if you click on, well, there's a whole bunch of places you can click on, but in the multifamily section, we've got all kinds of stats on different Florida markets and occupancy and vacancies. But I also do a series that are both under the multifamily tab and under the About Us tab called CRE Insights. And so I do a number of videos on how to invest. In fact, something very similar to what we've done today is on there, not as much detail, so I would certainly pay attention to this one before that. But there's other things on there on how to invest, what to look out for, pitfalls. We've done interviews on different stuff, but we've got a lot of we're always doing a lot of coaching and teaching through our website, and they can certainly contact us through there as well. And I'd be happy to help folks analyze things as well. It's what I like to do. It's actually kind of enjoyable.
Yeah, well, and I can recommend your site. I was checking it out prior to getting on the call here with you, and it's full of great information. You guys do a great job with all of your videos, and just very well done. So,
Thank you.
With that, Beau, I want to say thanks again for doing this. We'll have to do it again soon. And I want to thank all the listeners for tuning in today, because that's all we've got for you this week. Until next time, thanks for listening to Commercial Real Estate Pro Network CREPN Radio.